Well, good morning, everyone. We are expecting a few more people, but I want to make sure that we respect your time and respect Chris's time in getting this program off and running. Good morning. My name is Michelle Bomberger. I'm the founder and managing attorney at Equinox Business Law Group. I think I know many of you on the call. At Equinox, we provide outsourced general counsel services to growing companies. We help them to have a predictable cost and all-inclusive access to the legal team to build their infrastructure and to handle day-to-day challenges and opportunities in a proactive manner. The monthly focus event, which you're on today, is a program that we offer to bring forward topics of interest to our clients and our networks. Right now, as many of you know, since you're on this call, there's a number of trends in taxation, things happening both at the state of Washington level as well as the federal level. And since these questions continue to come up and people are trying to determine what they can do to plan accordingly, we wanted to bring this topic forward for everyone. So I'm really pleased to have Chris Tom from Hagen Kurth Herman join us today to talk about this topic. I've worked closely with this firm, with Chris and some of his colleagues on clients and business transactions, and I really, really appreciate the practical nature of the way they look at both tax and deals for their clients. So Chris, with that, I will turn it over to you to kick this off. Thanks so much for joining us.
Okay, thanks, Michelle, and good morning, everyone. I really appreciate the opportunity to present and talk about trends in taxation and what is to come with taxation, as well as how we got here. And of course, looking forward to the future at what we think will be passed with new legislation with the Biden administration, as well as with Washington State and Inslee's initiatives to look at taxation for individuals. So really appreciate the opportunity to talk this morning. So as we get into the trends, this is just the last two administrations and just some of their quotes on taxation. You know, where do we come from before we get into where we're going? And as we look at Donald Trump, when he was campaigning in 2016, he was devoted to cutting taxes. He said, I'm cutting taxes, we're going to grow the economy. It's going to grow at a record rate of growth. And that, you know, in hindsight, was actually what occurred. He followed through with that plan. And we'll talk a little bit about that through his Tax Cuts and Jobs Act. And then we have Joe Biden coming in with his campaign in 2020, saying that taxes are going to grow, are going to build back a better economy, boost it, create a middle class, and create jobs, paycheck protection program, healthcare, and confidence to come back. And so when we look at Joe Biden and his upcoming tax initiatives, we're really looking at what we see as tax increases on the horizon, and you know, looking at economic stabilization coming out of the pandemic, first and foremost, and then of course growing into 2022 with some of these initiatives taking place with his fiscal budget. So how did we get here? Well, if you remember back before Trump came into office, tax rates were at 39.6% for the top rate for individuals. The corporate tax rate was 35%. And the Trump administration really was looking on a worldwide scale and saying that businesses are not globally competitive with other countries' tax rates. And so through his initiatives, he created and was passed the Tax Cuts and Jobs Act during December of 2017. It was the biggest tax reform act since 1986. And what we saw with that was a large reduction in corporate tax rates from 35% to a flat corporate tax rate of 21%. We saw the individual tax rate fall from 39.6% down to 37%. But with that also came doubling of the standard deduction, removing tax exemptions for your dependents. We saw a removal of foreign tax deferrals. If you recall, that was during the time where companies like Apple, Microsoft were basically starting to repatriate cash back to the United States to spur economic growth domestically, without keeping kind of those tax deferrals in place. There was, at the time, a tolling tax on your 2017 tax return that essentially taxed all of those offshore deferrals in the immediate. In some cases, you could spread that over 8 years, but it was really an initiative to bring back that cash into the United States. And then we had an increase in foreign tax reporting complexity as a result of these changes with the foreign tax deferrals coming off the board. Things like GILTI and things like FDII, which are kind of buzzwords for the tax of foreign earnings in the U.S., as well as some of the deductions that come along with that for foreign intangible income. And then we had an impact on capital structures with the Tax Cuts and Jobs Act that eliminated for larger businesses interest expense if it exceeded 50% of a company's, or sorry, excuse me, 30% of a company's adjusted taxable income. They removed like-kind exchanges. They, created opportunity zones to spur investment into underdeveloped locations throughout the country, where a person could get a deferral as well as a permanent reduction of capital gains. And then a lot of these on the personal side, a lot of these provisions were they are set to expire following 2025. So things like the standard deduction increases, AMT, the alternative minimum tax kind of benefits that were there for individuals are set to sunset after 2025. And then along comes the pandemic. So a few years later, we end up with this initiative in the trend for tax to bring cash back to individuals as well as business to keep the economy going. And so this was the CARES Act, and then the CAA, which is up on the upcoming slide, was there to really keep money in the hands of small business, and to keep hands in the money of the most impacted people as a result of coronavirus. And so that introduced Paycheck Protection Program loans, EIDL grants, and other loans, employee retention tax credits to get a benefit on payroll tax. It started the economic impact payments that we refer to as stimulus payments. Economic stabilization investments came into play, where the government, the federal government would take an ownership stake in certain industries like the airline industry. They would take in a warrants or other stock in those larger companies to keep the businesses afloat during the pandemic. They reopened loss carrybacks, net operating loss, excess business loss limitations got removed, and that really was to, again, allow businesses, as a result of the Tax Cuts and Jobs Act, where businesses with a loss were no longer allowed to carry back those losses to get tax refunds. They just freed that up and said, we're going to go ahead and allow you to have a 5-year carryback to go and recoup some of the tax that you would have paid in the past. Really just, again, to put cash back into the business owner's hands. There was a deferral of Social Security, a deferral of tax payment delays, and so on for payroll tax. And all of that really is just a loan against the government or to the government to defer your payroll tax if they weren't able to be covered under the employee retention tax credit. They corrected, this was sort of a add-on, they corrected some rules that were in there for qualified improvement property. What this had to do with is there was an old rule for bonus depreciation, and there was a technical glitch in the Tax Cuts and Jobs Act that said that qualified improvement property was not allowed an immediate expense and had to be depreciated over 39 years as commercial property. And this would allow for qualified improvement property to be 15-year and allowed for bonus depreciation, so you could immediately expense those improvements. It just, again, it's really just to get cash back into the hands of business owners and individuals. And then along comes, a quick 9 months later, the Consolidation Appropriations Act. And the Consolidated Appropriations Act, it just was an expansion of the CARES Act. It reinvigorated, refunded the PPP loan. It allowed for a second draw on hard hit businesses and industries. There was a disagreement between Congress and the IRS, which sometimes does occur. And the interpretation on the original PPP loan was, sure, the PPP loan and debt forgiveness was not going to be taxable under the IRS rules, but the IRS said, but the expenses are not deductible. And this clarified and corrected that interpretation by the IRS and said, no, we truly intended these benefits to be deductible, to be not includable in income, and the deductions like payroll to be deductible. And so that CAA back in December did clarify that and correct that. And then it is allowing meals, which was formerly 50% deductible. It is now allowing them to be 100% deductible if they're purchased from a restaurant, which is a huge benefit and bump in the restaurant industry that's been so severely impacted by COVID-19. And then it extended the CARES Act charitable contribution for corporations. Formerly, a corporation could only deduct charitable donations of up to 10% of their taxable income, and this expanded it to 25% to invigorate the charitable giving initiatives across the country and keep those charities afloat that rely on donations. And so then as we look forward, and here's where we are setting the stage, that taxes in 2017 came down, and then they basically have been flat since that 2017 Reform Act. And then this sort of trend and wave of getting money back into the hands of taxpayers and business owners, to now we're looking ahead at Biden's tax proposals and where this administration is heading on a federal level. And so as we look at this, Joe Biden's tax proposals are really to stimulate the economy in a way that is building infrastructure. And so he doesn't think that in his plan, this Made in America tax plan, this America's Families plan, he doesn't believe that it will impact the government or the economy in such a way that is going to shrink the economy. But he thinks that this sort of increase in spending, which those initiatives are on infrastructure, clean energy, U.S. manufacturing, through several tax incentives, expanded healthcare, student loan debt forgiveness, education, and on-the-job training, and then temporary increases on refundable tax credits for families, that these initiatives are going to drive the economy and build infrastructures across the country to basically build what is a crumbling infrastructure with highways and ports and so on. Of course, that first priority, in this first 6 months has been on addressing the coronavirus vaccination distribution and economic fallout. So that has been there in the background, but now we're looking forward. He released his budget for 2022 that was released in proposed format on May 28th. It's referred to as the Green Book. And so that's what we're really looking at as a base as we look ahead. So on individual tax, the current rules, as I mentioned, the highest tax bracket is 37%. That sunsets on January 1st of 2026. So then going forward under the current rules, if nothing changed, there would be a shakeup in the tax brackets for 2026 and beyond. Currently, the top tax rate applies to single taxpayers that have an AGI of 200 or 523,000. And then for married filing joint, 628,000 is the top tax bracket. If you make more than that, that's what you pay. And then long-term capital gains are taxed at 20% at its highest rate, and then another 3.8% on top of that. So for a full rate of 23.8% if you include net investment income tax. Under the America Families Plan, there's a return to that 39.6% rate. So we're going from 37 to 39.6. And that's for married filing joint taxpayers of 509,300 or more. So that's also bringing down the top tax rate from 628,000 down to 509,000. And then households this is interesting, households that are making more than $1 million in adjusted gross income, they would be taxed at a flat rate of 39.6. So that graduated tax scale is basically gone for families that have a household income of greater than $1 million. And the other thing is that greater than $1 million would also provide for long-term capital gains and qualified dividends to be taxed at that flat rate, that 39.6. And so when we look at that, we're really looking at long-term capital gains having a huge increase for individuals from 20% to 39.6, so almost a 20% jump. When we look at corporations and business tax, what we're looking at is that corporations currently have that flat tax rate of 21%. And then certain international sales, which is called foreign derived intangible income, those international sales, if they qualify, are allowed a 20% reduction through this FDII. Well, what is being proposed is to implement a 15% minimum tax on companies that report more than $2 billion in income in the United States, but paid zero or negative federal income tax. That credit for foreign taxes and paid and carryovers from foreign tax credits are allowed under this plan. There is a 10% surcharge for offshoring your profits from sales on American soil by companies that has production offshore. So this is your company that would be manufacturing out of the country and bringing those products back to the United States to be sold. There's going to be a 10% offshoring surtax on those sales. And then internationally, they're pushing for a global minimum corporate tax rate of 15%, which is revolutionary to have this sort of global minimum tax when so many countries that would be signing on, Ireland, the Caymans, and so on, have either 0% tax rates or 10%, 11% tax rates. So this would be revolutionary. The G7 leaders have signed on to this, but is yet to be approved by Congress and kind of other nations outside of that G7. Other initiatives, so carbon tax. Currently, there's no tax on emissions of greenhouse gases. The Green Book plan does provide for a carbon tax. They want to expand credits for making direct pay. This 45Q tax credits, which is basically a credit for the metric tons of carbon dioxide that is captured and disposed of in geological storage units. There's a credit there, and so it does provide for an expanded use of that credit to provide incentive for carefully and responsibly disposing of CO2 emissions. Then we have other credits that we get into. So current rules, there is a work opportunity tax credit. It's non-refundable currently for tax credits for a portion of your wages. If you have an employee base that qualify, you have return to work from welfare to work, or you have military personnel that you're hiring into your workforce, then there is a work opportunity tax credit that's provided for providing incentive to employ those type of employees. It does, again, sunset on December 31st of 2025. And so first beginning 2026, your employee has to be employed before then to receive credit. And where this is going is that they want to expand the work opportunity tax credit to include military spouses. They want to create childcare construction tax credits to encourage businesses to put childcare at their facilities. Employers would receive 50% of their first $1 million of construction costs per facility, which would be a huge benefit. And then there's a 10% Made in America tax credit for companies that create jobs for American workers, which is available for companies that revitalize closed and nearly closed facilities, retool, expand your facility, just really have growth in this Made in America initiative. All right. It also provides for business credits equal to 10% of eligible expenses for onshoring. I talked a little bit about this. This is that surtax. And so if you're creating and having those eligible expenses onshoring your business to incur those expenses in the U.S., then you would get potentially a 10% credit. disallows deductions for expenses paid or incurred in connection with offshoring. So the opposite, it would disallow for deductions if your initiatives are to offshore. Creates tax credits for businesses equal to 25% of the qualified disaster mitigation expenditures. Just kind of a various amount of call it these credits. The child care credit, 50% of the first billion, so it's max total of 500,000 per year. And then it makes permanent the excess loss limitation on non-corporate taxpayers. I'm never really a fan of putting sections, code sections in here, but this 461L section, what this has to do with is back with the TCJA, it introduced a limitation on losses of $500,000 per married couple. If you have a pass-through entity or sole proprietorship that's incurring a net operating loss, your limitation per year is 500,000 for married, filing joint, and 250,000 for single. That went away with the CARES Act. It basically suspended those loss limitations for the next 2 years. And so currently in 2021, there is this loss limitation that is there for pass-through entity losses and sole proprietorship, so your Schedule C losses at 500,000 or 250,000, whatever is applicable to you. And so that again, under the CARES Act or under the TCJA was set to expire in 2025. Well, the proposal here is to make that a permanent limitation. And so it would be effective after 2026. The current rules for qualified business income deduction. So this is a deduction that was introduced by the TCJA. It provides for qualifying business income, so any income, trade or business income that is flowing through to you via a partnership or an S corporation, and then estates and trusts as well that are invested in other partnerships and S corporations, as well as sole proprietorships. They're allowed a 20% deduction of their qualified business income. And this would provide, so the Green Book would provide some limitations on that, where we're looking at special rules, essentially for real estate and other investors that would basically repeal deductions for taxpayers making more than 400,000. And so it would basically limit your allowance for those deductions if for higher income taxpayers. Okay, the TCJA removed the allowance for like-kind exchanges under the section 1031, those old 1031 exchange or like-kind exchange. It removed that ability to defer your gain on the sale of personal property. That happened with the Tax Cuts and Jobs Act in 2017, effective 2018. And now with the Green Book, what they're looking at is capping the benefit of like-kind exchanges as well on real property. So all of your real estate investor type property, it would be limited to $1 million for married filing joints. So your deferral would be limited if you have a higher AGI. And then for your single taxpayers would be $500,000 of kind of cap on the like-kind exchange benefit from sale of real property. All right, moving on to estate tax. And I know we're flying through this. There's a lot that goes on a day-to-day basis. So there's a lot here. So hopefully, if you want to refer back, these will be shared after the presentation. But the current rules for estate tax is the current exemption is about $11.7 million in 2021. And then assets that are passed at death receive a step up in basis to the beneficiary. So the tax burden in a current estate situation is on the estate and not on the recipient or the beneficiary of the estate. And so anyway, so that's the current rules. The Green Book ends that step up in basis. However, it pulls it back to $1 million and $2.5 million for per couple when combined with existing real estate exemptions. And so what this really does is at death, it's creating a transaction between the decedent's the decedent and in their final tax return and the tax return of the estate or the taxable estate, it's creating a transaction. So there's still sort of a step up in basis, but the tax is incurred due to sort of the built-in gain with really minimal exclusion. So it does treat that transfer at death, by gift or on death as a realization event. And that is effective next year. So definitely a big change proposed for estate tax, and will create a tax planning situation for those individuals that are going to be facing this here in the near future. The tax burden on multinational, international companies, we've talked about this a little bit, but the proposal under the Made in America plan is that it will create, so all of these proposals will create a tax increase of $1 billion or 100 billion in 2022, and then 1.2 trillion over the next 10 years. And it's essentially, it increases 81% and 72% relative to their tax liabilities under the current law. So certainly a large increase on the horizon here for multinational companies. There has been this push, that trend has been a race to the bottom. So what that refers to is worldwide, including the United States, there has been this push around the world to reduce tax rates for corporations to as low as possible. And this is going to put an end to that. So they're proposing a minimum tax on a worldwide basis of 15% of book income. And then it also looks to increase the US tax on foreign subsidiary income, which we call GILTI income, global intangible low taxed income. It will increase it from 10.5% to 21%. With big swing with respect to setting up a foreign subsidiary. And then there's this trend of an increased clarity, increased disclosure on international transactions. These are already out in draft format by the IRS, but there are new schedules behind your pass-through entities. Currently, you receive a Schedule K1 that reports all the buckets of income or loss that's flowing through from your business if it's a flow-through entity. If your business transacts on an international level, there are new schedules, Schedule K2 and Schedule K3, which will provide for enhanced international reporting. So another trend in addition to the increase in tax rates is also the increase in documentation, complexity, and just forms and information that is going to be provided to the IRS. The Made in America plan ends fossil fuel subsidies, the deduction for drilling wells, depletion of oil and gas deposits, domestic manufacturing. Those will all be ending under the plan. Repeals oil and gas related initiatives, and then it reinstates the super fund for estate or for excise taxes, to extend the excise tax on petroleum, domestic crude oil, and so on after this year. So just kind of the what's left in this. So the U.S. Supreme Court, just to throw this out there, a couple of years ago, as we think about and wrap up the federal impacts, the U.S. Supreme Court came out with a decision mid 2018 between South Dakota and Wayfair Corporation, and prior to this decision, remote sales from a company that did not have any physical presence in the state was not subject to sales tax by that state or sales tax collection. It was on the buyer, your customer, to report use tax in those states where use tax was, or sales tax or use tax was applicable to them. And the onus of collecting sales tax was not on the seller. And because there was no physical presence. And then this Supreme Court decision came out against Wayfair and said that if certain thresholds are met, then the seller has basically established an economic market in that state, and therefore there is an economic presence rather than a physical presence in that state, to where the onus of sales tax is required to be collected or is on the seller. And as a result, that really shook up sort of our client base when you have, you know, these remote sales of personal property, and it basically created these thresholds that many states are following today, here 3 years later, where if a company, or if a company is selling into a state that they don't have any physical presence in, but they have sales transactions during the year of $100,000 or more, or 200 separate transactions into the state during the year, then it creates an economic presence to a point where a company should be collecting and remitting sales tax. And it's all over the map. There are companies like Avalara that do track these type of things, and they do an okay job at tracking those type of things. But really, when you get into, we've talked about this a little bit as a firm with our clients, where you get into digital products and you get into, you know, the sale and download of products and storage on a server and so on. It really gets into the details, and really every state treats such sales a little differently, and where there is sales tax or not. And so we definitely would want to work with your service provider to help sort through where this is applicable. I don't want to beat that up too much on the sales tax end, but it really did flip things on its head when the Wayfair decision came out in 2018. And similarly, I'll skip a couple of these real quick. That also then impacts, you know, as we come out of the pandemic, we have these many clients, including us as a firm, where employees have decided to work remote. And so there may be where you hadn't been, you know, multi-state in the past, but because of COVID, you know, employees are using or working remote and using their vacation homes, or they're going to an Airbnb and spending an extended amount of time, you know, in states like Montana or Arizona, or, you know, just really anywhere. And where Washington state doesn't necessarily have an income tax, you end up looking forward at, you know, where I might have, or where you might have a physical presence nexus in some of these states where your employees have telecommuted from outside the Washington state. And all of the states are a little different as you can suspect. And so states like Arizona and California and so on have addressed this through, you know, various relief. And they said that, you know, if employees created a temporary home, you're not subject to, you know, physical presence nexus. Whereas, you know, states like New Mexico has not really even addressed it at all by this point. So definitely one of those things to reflect on as you close up 2021 and you're looking at tax planning is, where are your employees currently, and has your footprint as a company changed? Moving along, there's been an increase in 1099K, which is your online payment platforms. So anything going through online service channels, Airbnb, you know, any sort of transactions through Amazon, if you're selling through the Amazon platform, PayPal, any type of thing like that, you have to send 1099K to your employees. And I've heard that Amazon won't always do that for you if you're selling just, say, on Amazon. The onus of reporting that 1099K could be on you as the seller, as the company. So it's one of those things, just again, to look at and keep current on. There has been a big push this year, and it's in the Green Book, to budget for modernization of the IRS. It's long overdue, but we are looking at a 15% increase in taxpayer services, you know, funding for taxpayer services, an increase in IRS audit enforcement in their division, so a 5% increase there. And then multi-year software modernization, they received a 35% increase in funding for having better IRS software. So long overdue, and I personally I can't wait for that to come about and be complete. And then the other current sort of trend, just to kind of mention, is there's been such an increase in popularity with cryptocurrency, and the IRS and the rules around cryptocurrency is certainly behind the 8 ball here. And so when you look at cryptocurrency, currently it's treated as an exchange of property. So it's very much like selling a stock, where you have basis and when you exchange cryptocurrency, and that could be changing from Bitcoin to Ethereum or some two different coins. And so it's treated as selling one at a gain or a loss, and then buying another and having new basis. And so careful tracking, onerous tracking of exchanging cryptocurrency is the current rule. That isn't necessarily going to change, but what is being proposed is treating balances in your wallets and cryptocurrency balances as a foreign bank account, and so listing that on your FBAR reporting, if you have balances within your crypto accounts of more than $10,000 in aggregate, as it's denominated in US dollars. So you take all your crypto, convert it back to what the US dollar equivalent is, and if at any point during the year those balances are greater than $10,000, you have a reporting requirement. So quickly just going through planning on this. So obviously, we have taxes being increased, on the horizon. As business owners, you want to look at who's on your team, who's your wealth advisor, who's in your treasury, who are your people, and who's on your advisory team, and who's helping you along the way. As you consider what to do in your business, tax strategy, taxes are currently, say, 25% of your overall spend. And that is very quickly going to maybe 40% of your overall spend. And so as you're looking at that, who's on your team to plan around, preserving cash, adjusting your cash flow models to account for, distributions, working with your bank on what your covenants are going to allow for distributions to cover taxes, as this sort of is going to be a huge impact on cash flow. And then as you look at that, business strategies, reviewing your accounting methods, accelerating items of income into 2021 where tax rates are at, say, 21%, delaying deductions into 2022 so that the power of your deduction is at a greater tax rate, delaying CapEx investments. So any sort of property, plant, and equipment, maybe you are considering them and having that maybe purchased towards the fourth quarter of 2021. However, looking to implement them and put them in service in 2022, where you get a better deduction or a better rate on your deduction. Reviewing your entity choice, corporation, partnership, sole proprietorship to see if it's the most advantageous for you. And of course, you're looking at that from the lens of not allowing the tax results to drive your business decision, but truly allowing it to be understood. And if there is a better choice of entity type, looking at that from the perspective of it doesn't impact my business or it doesn't impact my clients or my customers. On the individual side, it's looking at where opportunities are to spread out your capital gains into multiple years, using and harvesting your capital losses to offset capital gains. If you're sitting on any dog investments, maybe it's time in, say, 2022 where you might have a big capital gain event to offload, and then looking at direct contribution of capital gains into charities allows you to remove that from your gain and take a charitable donation for your donation to the charity. And then, of course, retirement planning and estate planning would be key. Okay, so that was the federal front. We're going to quickly just go into just a couple more slides here in Washington State. So in April, it was voted and approved to have a Washington long-term capital gain tax. That is a tax effective in 2022 that will be taxed at a rate of 7%. This does not include capital gains for businesses that are corporations, but basically what the Washington State's going to do is they're going to look at your federal return and they're going to say, okay, what is your long-term capital gain on your federal tax return? And then what we expect is then they'll carve away from that the things that are not covered under this capital gains tax. So short-term capital gains, the capital gain from the sale of real estate. If you have a pass-through entity and that pass-through entity is private, and you sell your interest in the pass-through entity at a gain, but the value of the gain in your pass-through entity relates to real estate, then any capital gain associated with the real estate and the sale of your private entity, if the real estate is directly owned by the pass-through entity, is not applicable to the Washington capital gains. Very confusing, very poorly written, and so I hope that there is clarity in that when we actually have to implement, collecting and advising on this tax. Any gains on retirement accounts, family-owned small businesses, fishing rights, timber, and livestock are all excluded. This is really intended to cover the sale of stock options, and so on. It also is only intended to cover gain on the sale of tangible personal property if the property is in Washington State. So you get a credit if the capital gain is reportable and you pay tax on this, and say the sale occurred in California or Colorado or whatever, and you're paying income tax on that, there's a credit against the gain so that you're not paying gain again in Washington State. The exception I was talking about with family-owned businesses, it's available when you have revenue in the family business of 10 million or less in the prior 12 months. And then the ownership has to be more than 50% of the business is owned by you and your family, or 30% of the business if two families own more than 70% of the business, and then 30% of the business if three families own at least 90% of the business. So it's just kind of one of those exceptions to look at if that's applicable. Currently, there are two lawsuits saying, challenging the constitutionality of this new law. Washington State has in their doctrine that there's no income tax allowed in the state, and that's been shot down a few times by voters. And so Douglas County has two lawsuits that is expected to go to the Washington State Supreme Court and to challenge the constitutionality of this. So certainly something that we're keeping an eye on. And just some planning ideas here. The law isn't scheduled to take effect until 2022. So if you have, or if you know of anyone that does have capital gains that they may be applicable towards this tax, it may be a good time to sell if they're looking at selling anyway, in 2021. And then consider gifts to individuals or trusts that the beneficiaries have lower income. I've had a lot of clients look at this, and I've had one client say, does it make sense for me to move out of state? I'd just be sitting on quite a bit of capital gain, unrealized capital gain, and so we've helped model out their domicile and where they're able to save long term and so on, and really look at the big picture, because Washington State is one of the few states that has an estate tax, but many states have an income tax with no estate tax. And so looking at the big picture and the balance of in the long term, where does it make the most sense for an individual to reside on a residency basis. And then just sort of lastly, looking at the upcoming long-term care insurance, and I don't want to steal Michelle's thunder here, so just to mention it really quickly as a quick introduction, Washington State has passed and is upcoming long-term care insurance, and so that is going to impact basically all W-2 employees in Washington State that receive a W-2 and work at least 500 hours a year. Beginning January 1st of 2022, there's this new payroll tax at 58 0.58% or 58 cents for every $100 or that a person earns. So, you know, every 100,000 in W-2 compensation is $580 of premium that's being paid to fund the long-term care insurance program. There is an opt-out if you can, if you have a better or more comparable plan, you can opt out of this plan, but you have to do it by November 1st. And there is a sort of window. I've heard from insurance companies that you really have to be in their pipeline as soon as possible, because they're really, you know, they're putting a huge amount through their pipeline to get approved and underwritten before that November 1st deadline to make the deadline. We are hopeful that that deadline gets extended, but at this point, going off the current rules, November 1st is the current date that you have to have a comparable insurance plan in place to opt out of the 0.58% long-term care insurance. So that is all for me. Michelle, you can take it over.
Yeah, I think we have about 5 minutes remaining for questions. If anyone wants to either pop that in the chat or feel free to unmute and ask a question directly. That is, you know, there's a ton of information here. I think it's going to take a little bit of time to digest it, but if you have anything pressing, feel free to ask that now. And one of the things that we've seen while we're waiting for that, Chris, is a lot of folks who have been thinking about selling their businesses. You'll see that the transaction volume this year is pretty aggressive, and I think people are trying to get out from underneath this potential risk of the capital gains taxes going forward. What are your thoughts on that?
I agree. There's been a big uptick in transactions, and even just consulting around transactions to prepare for this. And, you know, one of the nice outs on the long-term gain is, you know, as it relates to Washington, is the small business exclusion. But if you know, people are over and above, you know, the revenue, you know, maximums and so on, where they're going to be applicable, that's key. And then looking at beyond just Washington State, you know, this long-term gain, if you're going to have this gain of greater than $1 million, causing your AGI to be over $1 million, you know, it's really, you know, hey, can we get this done in 2021? So they avoid the sort of 37 or 39.6% long-term capital gain hit if they're greater than $1 million on the individual side. So, and then, you know, looking at structure, when we talk about structure, you know, there's a qualified small business stock exclusion from gain. And if a person owns stock in a C corporation and they've held it long enough and it's in the right industry group and so on, there is a long-term gain exclusion. And so I think going forward more, and that was made permanent. And so going forward, I think, you know, consideration of your exit as a business owner and knowing, are you in the right structure long term, as well as are you in the you know, in the right structure for you as a business? You know, some of those considerations are key, you know, as we look at long-term capital gains potentially going up to the top tax rate.
So, you know, recognizing, of course, that you don't have a crystal ball, you know, most of this is proposed. I mean, obviously in Washington it's passed, but it's, you know, potentially it is under attack. And then a lot of the federal stuff is proposed. What is the likelihood from kind of what you've seen and heard of, you know, either or both of these things coming to fruition? What should we be most concerned about?
I think that a lot of the federal stuff is going to pass. I was reading that this morning on Forbes, and you know, it's looking like there's a lot of wind behind the sails of many of the proposals within the Green Book. They have some of the sort of moderates that they need to win over, but Washington DC seems confident that they can win over enough votes. So I think that a lot of Biden's proposals would pass. The one concern I have is whether the economy can afford they're proposing a 28% corporate tax rate. I think they may settle in the short term on like 25% without having that 6% jump immediately. But I think eventually, they're going to want 28%, and that's the push. I just don't know if they're going to dip their toe in the water at 25 and then watch it and see how the economy reacts. And then balancing it with interest rates. Interest rates have still stayed at very low rates. And so I think that economically there's a balance between what the corporate and individual tax rates are, and then what the Fed does with interest rates.
We have a couple of questions that have come into the chat, so we'll tackle those two. And sure. Then if other ones pop up, we will include those in the summary email that you will all receive, because we won't have time to tackle probably more than these two. So the first one, the 15% book income is after all deductions or straight gross annual sales?
After all deductions. It's the book income is what the way it was written, and the way I understand it is that it is based on what you report to your shareholders, investors, owners. So it's literally your book income under whatever standard of accounting that you're using. So it's after expenses.
Great. And then the second question, could you recap on the proposed elimination of stepped up bases for federal estate tax?
Yes. So the proposed elimination is essentially that currently when property is passed to a beneficiary of an estate, it's the basis of that property is stepped up to fair value at the date of death. For the most part, there's some exception where you can use 6 months later, but for the most part, it's at the date of death. Whatever that fair value is the recipient's basis. Currently, that works, but there's this $11 million exclusion from the estate that says, okay, well, the state isn't subject to any sort of tax on a federal level if you have 11.7 million or less in value. And so the rule is that now much smaller estates, I think it was like $2 million in value, anything more than that is going to be subject to the estate being taxed as if the assets were in a recognition event, as if the assets were sold to the beneficiary. And so there is a sort of a step up to fair value, but the estate is going to pay that at a much lower rate. And it's, again, as if these assets were sold at fair value. So that could be greater than or less than the current basis within the estate. So I think the way it's written is that it's an elimination of the step up in basis, but I mean, truly the beneficiary is still getting the basis, but the onus of the tax is on the estate to pay that as if it was purchased by the beneficiary.
The devil's in the details, right?
Yeah.
So, well, thank you so much, Chris, for joining us. If you want to pop to the next slide for me.
Yes, absolutely. There we go.
So as I mentioned at the beginning, we host these focus webinars every month. Chris mentioned briefly that we are planning on doing a program on the Long-Term Trust Act in Washington next month. If this is something that you haven't looked at yet, getting on it sooner rather than later is critical. The industry is really being overwhelmed by folks looking to opt out and obtain secondary or outside of the plan long-term care plans for themselves. So we'll cover this next month in our program. But if you have a financial advisor that you're working with or you have questions, feel free to reach out to them or to us. We'd be happy to give you the 30,000 foot before that. And then in September, we're going to do a program on avoiding the mass exodus. You may have heard, it's very common in the press right now that people are being very comfortable in leaving their jobs, either because they're being required to come back to work or because they found alternatives. So how do you think about this as a business, transitioning back into the workplace and avoiding the loss of key people? So we're looking forward to bringing in a panel discussion for that topic. Again, Chris, thank you so much for your insights today. This program is being recorded. It will be on our YouTube channel, and those of you attending will get copies so you have a reference, because there was a huge amount of information in there. And I was scribbling frantically, and maybe you were too, but this will be available to you in the next couple of days. So thanks so much, and have a great day.